I've got a very good friend who's in commercial real estate private equity, and he said to me, this is way worse than the global financial crisis. He said, this is way worse. People don't realize it yet. It's going to kick in the next 12 to 18 months. Winston and Felix here. Commercial real estate just took another hit. And this is the beginning, in my view, of the wipeout blow. What have we got? Well, if you look at the delinquency rates of commercial mortgage-backed securities, short CMBS, which is essentially bunches of mortgages packaged together, those delinquencies have jumped 4.5% in June. Now, that is the highest increase in 23 years. So not since 2000 have we seen such a jump in delinquency. So 4.5%, a little higher probably if you count those who are not repaying but still paying the interest. It's starting to look like a real estate crisis. Now, it's going to be interesting, I think, because there is a structural change underneath here, so much so that Winston has to eat a stick. And what's that structural change rather than some sort of temporary thing? Well, companies are realizing we don't need offices this size. People don't want to come back to the office. We don't need to have expensive offices in the center of cities that are a dump, that are unsafe, that have high rent, where our employees do not want to be. So you get lots and lots of vacant office space. At the same time, you get lots and lots of increases in interest rates by the ever-idiotic Federal Reserve. And that means most of these CMBSs, these mortgage instruments, have variable interest rates. So interest rates go up, rents go down because there's no one in the blooming buildings, and you've got landlords like Blackstone defaulting. Private equity firm Brookfield, they're huge. They're defaulting. So why are they doing that? Well, they lose the equity, but they haven't really got any equity left because they don't think the buildings are worth what they originally paid for them. So they just stop paying. So you've got, for example, 2 A-class towers in Houston were sold by the bag holders of these CMBSs for 88 and 82% less than what they were previously valued at. You've got the AT&T tower in San Luis that was sold at a total loss. A total loss. Complete wipeout. In San Francisco, you have office towers selling at 70% discount to pre-pandemic prices, and lots of office towers being sold at 40 to 50%. And I've got a very good friend who's in commercial real estate private equity, and he said to me, this is way worse than the global financial crisis. He said, this is way worse. People don't realize it yet. It's going to kick in the next 12 to 18 months because people are having to refinance and they're struggling to do so. So it's structural. It's not going to go away. What does it mean? Well, what if interest rates came down magically? Fed's telling us the opposite. Well, if your office building is empty or half empty, you're still not going to be able to pay your mortgages. So what's going to happen here is that people will default on those mortgages. The bag holders will sell them at a discount, and then the cockroaches will snap them up. Who are the cockroaches? Remember I mentioned Blackstone, the guys defaulting on buildings? Well, they have raised the fund to buy defaulting real estate. So they might just buy it back themselves at a really, really, really low price because nobody wants this stuff, and then they make money out of that again. So big money always makes money. And that's really the important thing to learn, I think. And I think further to this is, Winston says there is something more important. Small and regional banks finance a lot of commercial real estate because you've got a local building, you're going to go to your local bank, right? So they will have to write off lots and lots of mortgages, and they can't afford to. So you're going to get another banking crisis. Is it number 2? Is it number 3? Is it number 4? I've kind of lost count on that one. So what are we going to do about it? Well, we've got to focus on making money in the short term, regardless of what the market does on the longer term. We trade 3-4 hours a week, which is why we can hang out here in the park. And we're about to do some exercise by hanging off that tree up there. Yeah, exactly. And come and join me and learn how we do that. I'll teach it to you for free on Tuesday, the 11th, felixschwenz.org/webinar. If you've got an hour and a bit, then I'll run you through my entire strategy that I learned as a banker, as a hedge fund strategist, and show you actually live how we do some trades. So we set up some trades together. Winston will help out, and you get out of this thinking where you think, well, if the market goes down, my portfolio goes down. It doesn't have to be that way. you can generate money when the portfolio goes down, and you can buy more great companies at lower prices, and you can actually enjoy a dip in the market. And I'd love a dip in the market. I can buy more great stocks at lower prices. So that's it for me. And Winston, smash the subscribe button. And Winston says, let's go and find some more sticks to chew, maybe even a squirrel or two. Don't worry, he doesn't get them. He just runs after them. It's very exciting, isn't it, squirrels? Any last words, Winston? Snacks, I think, might be required. Have a beautiful day.